Hello and welcome to Nit70, here with another video with a great message for you, so make sure to watch till the end and subscribe to this channel. What is RSI? Let me give you an outline. The Relative Strength Index formula, or RSI, was developed in the 1970s, like many other technical analysis concepts. The Relative Strength Index calculation is made by calculating the ratio of upward changes per unit of time to downward changes per unit of time over the look-back period. The actual indicator calculation is more complex than we need to worry about here. What's important to understand is that if the look-back period, for example, is 10 units of time or candles, and every single one of those 10 candles closed up, the RSI would show a number very close to 100. If every single one of those 10 candles closed down, the number would be very close to 0. If the action is completely balanced between ups and downs, the RSI indicator would show 50. The Relative Strength Index definition is a momentum oscillator. It follows whether the bulls or bears are winning over the look-back period, which can be adjusted by the user. The objective of the RSI indicator is to measure the change in price momentum. See, the RSI is a leading indicator widely used by technical critics around the globe. Moreover, RSI can be used to look for failure swings, divergences, and centerline crossover. It spots a general trend, like how it's considered overbought when it goes above 70 and oversold when it goes below 30. These traditional levels can be adjusted to better fit security. For example, if security is repeatedly reaching the overbought level of 70, you may want to adjust this level to 80. It should be noted that during strong trends, the RSI may remain in overbought or oversold for extended periods. RSI often form chart patterns that may not show on the underlying price chart, such as double tops and bottoms and trend lines. Also, look for support or resistance on the RSI. In an uptrend or bull market, the RSI tends to remain in the 40 to 90 range, with the 40 to 50 zone acting as support. During a downtrend or bear market, the RSI tends to stay between the 10 to 60 range, with the 50 to 60 zone acting as resistance. These ranges will vary depending on the RSI settings and the strength of the security or market's underlying trend. If underlying prices make a new higher low that isn't confirmed by the RSI, the divergence can signal a price reversal. If the RSI makes a lower high and then follows with a downside move below a previous low, a top swing failure has occurred. If the RSI makes a higher low then follows with an upside move above a previous high, a bottom swing failure has occurred. Although it may sound counterintuitive, particular use of Forex indicators can actually cause an inexperienced trader to lose money rather than make money. However, if you are going to use one, the best Forex indicator is the RSI because it reflects momentum, and it's well established that following Forex momentum can give you a winning edge. The best way to use an RSI is to trade long when it's showing above 50 on all time frames, or short if below 50 on all time frames. It's best to always trade with the trend of the last 10 weeks or so. The most common reason that RSI is popular is that its value is always between 0 and 100. This makes it easy to read and form opinions about the asset. So, now you know all the reasons why RSI is one of the best indicators. What did you think of this video? Let us know in the comment section. And if you like this video, then don't forget to hit the thumbs up and subscribe to this channel for more amazing videos. Also, hit the bell icon to get notified first and share it with your friends. Thanks for watching. We'll see you in the next one with another edifying topic.